Bill Faeth here from Build Short-Term Rental Wealth, and thank you for joining me today. I know it's playoff Sunday, and we got one game down today. It looks like the Eagles got their tail handed to them by Tom Brady earlier, but I think that was expected for everybody that didn't live in Philadelphia. Now, don't get me wrong. I've caught enough shit from people saying, about the time slot today. I get it. Tried to sandwich it right in between games. I know the Cowboys are, coming on tonight against the 49ers. But you know what? I got a lot more important stuff that we need to talk about today, and that's the future of funding. Unless you've been under a rock, you know that Fannie and Freddie just raised their second home interest rates, and I think that's really, really important, as a lot of you have been trying to go that second home route. But there's a lot of other options that are out there as well. We have commercial loans, we've got bank loans, we got hard money, we got Dscrs. There's a tremendous amount of options for all of us as we try to scale and build our short-term rental portfolio. So today I'm joined by a friend of mine, and actually someone that I've used in my last two deals. And if you follow me closely, I'm getting really super close to buying in Montana. I'm going out there in another week and probably going to buy two properties as opposed to one. And I love the options that the gentleman that's going to join me today has with his own programs. We'll talk about that a little bit later, because right now it's really about what's happening. And him and I have had some dialogue about this, and I hope that you have too in your own small groups, or that you surround yourself with, because it's a really important time that we are all keeping our eye on the economy, especially if you're looking to either dive in for the first time into short-term rentals, or if you're looking to expand. So without further ado, let me introduce Chris Ledwidge. He's one of the founding partners at The Lender, which specializes in debt service loans, DSCR loans, which in my opinion are the easiest to qualify for. So let me bring him up on stage. Chris, how are you today, my friend?
I'm good. How you doing, Bill?
I am doing fantastic. I mean, you must be hanging out in Big Bear if you're like growing the winter kind of skiing beard, right?
I'm getting back to my mountain boy roots.
I love it. And that's actually something I forgot to mention. Chris actually is an STR investor and a host, as we are. He has a place in Big Bear, California. And you should be out there skiing instead of being here with us.
Oh, I got my fair amount of skiing in over New Year's, so I'll be heading back up there later this month. But yeah, I'm glad to be here on this Sunday to talk about interest rates, the future of STR lending, kind of the landscape of non-QM lending, and hopefully share some insights with everyone that's tuning in today on how to best shop your mortgages and how to really do your due diligence when you're deciding on your financing.
Awesome. So this is for you guys. So if you're here, it doesn't matter if you're on YouTube watching this live, if you're in my mastermind group, Build Short-Term Rental Wealth, we're broadcasting this in 6 different channels. Number one, Chris and I would love to know where you're at. So just drop a comment in, say hello, and let us know the town that you're from, the city that you're from, and then use the comments to ask your questions. I know you guys are probably going to have a lot of questions for Chris, but I'm going to start us off with the very first one. Chris, Fannie, Freddie, second home rate increase coming, I believe it's in March. I don't remember the exact date. I guess the first question is, have we passed the date to be able to lock in, or can we still lock in on those rates? And kind of just expand on that, and then I'll kind of just let you take over.
Yeah, so we're probably in the last 10 days or so of locking in those rates. The actual effective date on that Fannie product is April 1st, and that's for all loans delivered to Fannie on or after April 1st. And what that means is you're locking in loans today. Those lenders are funding those loans, but they're not selling them and shipping them off to Fannie for usually 2 to 3 weeks after those are funded. So you're going to see lenders pricing in the adjustments to these second home mortgages here probably in the coming week or two. And just to clarify, what Fannie did here is they levied a loan level pricing adjustment. So it wasn't an actual interest rate hike. What they did is essentially was make second home mortgages more expensive. And it's really determined, what is an LLPA? An LLPA is a loan level pricing adjustment, right? So when you're looking at a Fannie loan, a Freddie loan, or even an FHA, VA type loan, there's loan level pricing adjustments. And those loan level pricing adjustments are based off of loan to value. They're based off of FICO scores, and in some cases, they're based off of debt to income or property characteristics, right? Condo, second home mortgage, investment mortgage, or even high balance mortgages now are in that bucket with the second homes. And what we've seen, the most significant impact really it falls in the second home mortgage when putting only 10% down, so the 90% loan to value. And what we're seeing is a 4 and an eighth, so 4.125% increase in fee on those second home mortgages at 90% loan to value. And what does 4.125% in fee translate into interest rate? That translates anywhere from 1 to 1 3/8% on interest rate, right? Depending on the lender and the day that you're getting price quotes. So yesterday's par rate of maybe 3.5, 3.625 on a second home mortgage will really very soon here be, mid 4.5% on those second home mortgages. And the reason I was reading up a little bit more on this just this morning, and the reason Fannie levied this new loan level pricing adjustment is because there's a concerted effort on Fannie Freddie to create affordable home ownership amongst first-time home buyers, right? They want to make sure that our tax dollars that support these government-sponsored enterprises are really being used to spread the wealth or the affordability or the liquidity to first-time home buyers. So this implementation of the loan level pricing adjustment is in my opinion it's a good one. I think we as lending practices go, especially as it relates to our tax dollars, should be there for primary homeowners and in many cases first time home buyers. The investment purchases, the second home type purchases, we don't want our tax dollars propping up those type of loans, right? And Fannie knows this, and they're trying to retreat from that a little bit to create a little bit more stability in their lending practices. So all in all, we're still 4.5% on the interest rate, which for a second home mortgage is still really good. There's still many advantages for that Fannie second home mortgage as compared to other type of investment property solutions, whether it's Dscr, asset depletion, bank statement loans, or fix and flip, or whatever you're looking for. So what does this mean in a broader sense? I think what it means is you're going to see this is the first actionable step amongst Fannie to kind of slowly retreat from those non-first-time home buyers or non-primary residence type loans. And what this is who's going to step in and fill that space? That space is going to be really filled by the non-QM market, private money, hedge fund equities that are lending on these type of assets. And I think what you're going to see here is an evolution or a replacement of these type of loans through hedge funds, and you're going to see the non-QM market really kind of expand in its offerings for second home mortgages, investment properties this year.
So it's kind of interesting that if you think it's going to be close to 4 or 5 in April, depending on some other factors, right? I mean, I think the last loan I just closed with you was probably late November, mid to late November, maybe, mm-hmm. And I was at like 4.25 for a DSCR, which I think there's this misconception that DSCR is way higher. You're going to be paying probably 2 points higher. Mm-hmm. Origination fees are significantly higher. All those types of things. So, I mean, I think what I'm hearing you say is, okay, well, now it's going to pretty much be in line. You're going to have a traditional second home loan. You can go to your bank and get a traditional banking loan, but you're probably going to be on a 20-year AM versus a 30-year AM on a Fannie or Freddie, or a 30-year AM with you on a DSCR. So your payment, your cash flow is going to be less, right? Payment's higher, cash flow is going to be less from an investment standpoint. But essentially, the interest rates are starting to level out across all platforms. Is that what you're seeing as well?
Yeah, I am seeing for the moment, I'm seeing the interest rates as compared to, Fannie and DSCR loans and commercial type loans level out for the moment. What I am anticipating probably towards the end of the second quarter, maybe even a little bit earlier, is you're going to see some of these DSCR loan rates creep up. I was on a call last week with one of our larger hedge funds, and the way these things work is we make a commitment to sell X amount of number in volume to these hedge funds. They make a commitment to buy X number of volume from us. And it's called a forward, right? A forward commitment. And we're nearing the end of a forward commitment that we originated with our hedge funds around August of last year. It was about a $350 million forward commitment. And we're about done filling that pool of loans. And on this call with them last week, we touched on a lot of different things. We're working on the new forward. What are the terms of this new forward commitment that we're originating with this hedge fund? We talked about air DNA was a very, very big topic amongst ourselves and this lender, and how it's being utilized in lieu of a rent survey, and how we're going to continue to use that, or in accompany that with other tools to determine short-term rental income. But also the big thing that I noticed on the call that was mentioned that gives me or at least makes me feel that there might be an increase in these DSCR rates, is the securitization fees on the secondary market. Securitization fees amongst the hedge funds have gone up about a factor of 2. So they're seeing it's more expensive for them to securitize these loans and service these loans. So they're talking about passing that cost through to the lenders, and then the lenders naturally have to pass some of that cost through to the consumer. Right now, most of your outlets for these type of loans, no one wants to be the first one to raise their interest rates, right? No one wants to be the first one to, kind of handicap themselves by raising these interest rates. That being said, I think soon enough here, you're going to see some of these rates on these DSCR type loans go up. That being said, I also think with the expansion of the non-QM market this year, last year there was about 25 billion in non-QM business originated and funded. This year they're expecting about a 40 billion origination funding on non-QM business. But I believe that, the refinance boom is over, right? We're not seeing people, refinance to get that 2.75, and you're going to see a lot of mortgage professionals pipelines dry up. Right? How are they going to originate loans and make a living? And they're going to have to reinvent themselves and get into more loan products, of which non-QM is going to represent a lot of that. So now you're going to have supply and demand, right? In 2021, there was a fair amount of supply of non-QM originators out there, and there was a fair amount of demand. In 2022, I think you're going to see a lot more originators, lending companies get involved in the non-QM business DSCR. I'm already seeing, just in our groups that we frequent on Facebook, more DSCR type advertisements, and lenders putting themselves out there, which I think is a good thing. We want to see the competition. We want to see an abundance of opportunities and options for the consumer out there. But what's going to happen there, I think that's going to hold off the increase of interest rates. We might see an 1/8, maybe 1/4% increase on these DSCR loans. But you're going to see more options out there available, more outlets, I should say. And what usually follows that, and I think is going to be another thing that we experienced in this year, it was something that we experienced in 2019, late 18, 2019, is margin compression, right? So what is margin compression? How is it going to affect the consumer and the lending practice? That means that there's just less money being made on these type of loan products when the lenders are originating and funding them. And couple that with more lenders getting involved in this, you're going to see a much more competitive environment. So although it might go up 1/8 or 1/4%, where I think you're going to see the advantages in fee, right? The fees on these loans typically is ranging anywhere from 1 to 2 points. I've already seen the competition out there. We've set ours in your group and for your clients at 0.5 point origination fee, right? Our standard origination fee is 1 point. Anyone that's part of Build Short-Term Rental Wealth gets a 0.5 point off of that 1 point. But I've seen our competitor, I often advertise, send me your rates, send me your best quote from your competitor, and we're going to find a way to beat it. I have seen the origination fees coming down, right? I've seen more, the rates are comparable to what the lender's offering, but I've seen the fees come down from 2 points to 1.5 to, in some cases, 1 point, which I think is a good sign. That just means there's more offerings and more options out there for the consumer to wisely go out there and shop their services. Couple that with margin compression and more offerings out there, I think all in all, it's going to be a good year for, the DSCR non-QM lending and the options for the consumer.
So you referred to lenders. Can you explain the difference to the people that are watching between a direct lender that's working with those hedge funds and working on the forwards like you do at the lender versus a broker? So we have two big players prior to you guys coming into the short-term rental space that have been here for a while. And they're both brokers, correct?
Yeah.
As opposed to, I think people think they're the direct lender, and that's why the boot camp in October, you did a side-by-side comparison, and you're talking 2.5 times the origination fee. If I remember correctly, I think it was like 33,000 versus 10,000, meaning that other lender was 33,000, you were roughly 10,000. Your interest rate was like a quarter or a half a point lower. So what should they be looking, and how can they vet to know that they're going to a lender versus a broker?
I would just ask them, right? And the truth is brokers are going to be better in some situations than a direct lender, and a lender is going to be better than a broker in some situations. A direct lender, a retail outlet like the lender that I operate, is going to excel when it comes to non-QM type products, so DSCR, bank statement loans, asset depletion loans. Because when a broker originates that loan, we have a wholesale channel. We work with over 3,000 brokers here in the United States. And when they originate that loan, they'll send it to us for us to underwrite and fund that loan. But in order for the broker to be compensated on the deal, they must charge the borrower a borrower compensation fee, right? That's where you see points often referred to, right? And they're again looking for 1 to 2 points on compensation for those deals that they originate, as where a direct lender, and you're working directly with my mortgage analyst or someone on my team, we don't pay them 1 or 2 points. We pay them half a point on the origination. So I would just ask them, are you a broker or are you a direct lender? And if you're looking at a non-QM product, I really think the direct lender outlet is going to be most beneficial. When is a broker going to be more beneficial? Well, there's, I would say for your conforming Fannie Freddie, I think they're going to be a better outlet. There's a company by the name of UWM. They are one of the largest. They're doing $7 billion a month in funding on these conforming type products. And they have a different strategy for making their money and growing their business. Their strategy is to build a servicing portfolio, right? They don't care about the origination fee or the points that they're charging. They want to get that loan. They want to give it an exceptionally low interest rate. They want to tuck it away in their servicing portfolio where it's not going to, run off or go away for the next 7 to 10 years. And that's where they make their money, right? So that would be your Fannie, primary home mortgage, your second home mortgage. That's really, if I were going to originate my own loan on a second home, I'd probably go to a broker for that, because they are really just buying the market, these broker outlets like that.
That's interesting on that strategy, because the majority, it seems like, through banks or going direct to lenders, are actually selling. They're making their money on the origination and then selling the asset after close.
Yeah.
Someone asked a question. I don't know who this is, but I'm going to pull this up. How will this affect second home buyers who plan to put down 20 to 25%?
So 20 to 25%, you're seeing about a 1 1/8 loan level pricing adjustment. So that might be a 0.25% increase in interest rate, right? Now, as compared to the 90% LTV, someone just putting 10% down, that's seeing nearly 4 times higher fee on that. So I'd say 20% down, you're seeing about a 0.25% increase in interest rate with the new FHFA announcement on second home mortgages.
And they won't get a lower interest rate if they're putting 25% or even 30% down.
No, the loan level pricing adjustments are really going to be in increments of 5, from 10% to 15%, 15 to 20. And then there is no more improvement on the loan level pricing adjustments going above 20.
But if I want to do an LLPA and put 25% down with you versus standard 20, do I get a lower interest rate?
We actually I think it was about a month and a half ago, we wiped out the difference between interest rates between 20 and 25%. So prior, when you're putting 20% down, you got about 1/8 to a 0.25% better on interest rate as compared to 25% down. We washed that out, so it's the same whether you put 20 or 25% down.
Gotcha. So can you still buy down a point if you want to?
Yeah, on the DSCR loan, you can still buy down your points. Or
can you do that on the Fannie and Freddie if you wanted to buy back down?
Absolutely.
Okay, gotcha. Cool. That's awesome. I think that one of the things that I want to reiterate, and first and foremost, if you guys are watching, please ask your questions. That was a great question that we just had. Put them into the comments. There's multiple ways that you guys can get your funding, and it's interesting. I've got a client right now that I'm helping source a property. And he had a very a very bad 2020, as a lot of business owners did. So he's not able to go through the traditional Fannie and Freddie route. He's got a couple $100,000 in cash. He's had a great 2021, but specifically, if you haven't and this is what I see as a dichotomy right now for a lot of you. One, you've got like 10 days, as Chris said, if you want to lock in that Fannie and Freddie, and you really probably need to have a very, very upfront conversation with your broker to make sure they're going to be able to get it filed prior to that April 1st deadline, right? Is that what I heard you say, Chris? Mm-hmm. But you also, if you had a shitty 2020, like I did and some other people did, but you've had an incredible 2021, you're not going to have your tax return filed by then, most likely. So if that's the case, then you probably need to look at one of the non-traditionals. And here's why I think it's really important. Chris, can you kind of just give a snapshot of what it takes to qualify for you specifically and most DSCRs? Because you don't ask for income statements. You don't ask for personal or business P&Ls. You don't ask for my last 2 or 3 year tax returns. The qualification process is different than a traditional loan. And I don't think a lot of people understand the difference. Can you explain that?
Yeah. So the DSCR loan, debt service coverage ratio, is a business purpose loan on a non-owner occupied property. This is really being looked through under the lens of a business loan. Okay. And so we're not looking at the individual's ability to repay the loan. That's the industry term, ATR, ability to repay. And when you're doing a Fannie loan, you're looking at the individual's ability to repay the loan. That's where we look at income statements. That's where we factor in their debts, and we come up with a debt to income ratio. With a DSCR loan, we are looking at the subject property. And what we're looking for is a 1-to-1 ratio. We want to see that the subject property produces enough rents to cover principal, interest, taxes, insurance. And as long as we hit that 1-to-1 ratio and the borrower has a good, clean credit history, we move forward on the loan. It's really that simple.
That's awesome. Let's see. Steve Ovitz has a question. Any changes to investment loans?
There was no changes made to investment loans in regards to loan level pricing adjustments. And part of that is those loan level pricing adjustments were already baked in to the Fannie Freddie investment loans. So more or less, second home mortgages kind of balanced out with investment loans on Fannie and Freddie.
Awesome. If we're looking at April 1st with that rate, not a rate increase, but what did you refer to it as? I keep calling it a rate increase.
LLPA, loan level pricing adjustment.
The loan level pricing adjustment. What do you anticipate? And you're probably a person that has their nose to the grindstone more than anybody that I've ever dealt with. Like you said, you were studying it and reading up on it on a Sunday morning with football going on. Where do you think we'll be at middle to end of summer, 6 months from now?
Good question. I think we're going to see interest rates reach 4%. Now that would be for your, Fannie Freddie owner occupied loan. I think you're going to see second home mortgages creep to 4.75, 4.875 by the end of this year. At the 10% down.
Right. How do you determine that 1-to-1 ratio? You go solely off of AirDNA?
Yeah, so currently we've been going solely off of AirDNA, or I should say in lieu of the 1007. What is a 1007? 1007 is a rent survey performed by the appraiser at the time that they do the appraisal. It's essentially, the appraiser goes out to the subject property. They are looking for short-term rental data that they can use and throw on a report. It's not all that more accurate than what we're getting from AirDNA. In a lot of cases, it's less accurate. So again, back to this forward, right? We're in a forward commitment with one of our hedge funds right now that we're selling to. And we are selling loans with just AirDNA or AirDNA in lieu of a 1007. The hedge funds out there, we're selling to 5 different hedge funds, but they're not 100% on board with the AirDNA. And I know there's many lender or outlets out there that are using AirDNA solely. I expect that I do foresee that getting a little bit tighter. I think what's going to happen is it's going to be on an exception basis to solely use the AirDNA. I think only will we use AirDNA when the individual borrowing has a 1-year history of short-term rental ownership and operating. And what are they going to do I think what they're going to probably do is want to see a 1007 and an AirDNA report. Now, if we can't get a 1007 or we're trying to close quickly, we can still originate and do that loan. It'll just sell for less. Now, again, this is what lenders are going to want to stay competitive. Are we willing to take the hit on the loan and sell it for less and just use the AirDNA? Well, yes. I mean, I can say that much for the lender, at least the retail outlet, because the way we run our business, consumer direct type model, we have much lesser fee to originate and fund our loans as compared to a broker. So I'm willing to, take that approach, the Walmart approach, if you will, where I'm going to keep my prices low. I'm going to, keep my fee, my adjustments low, so I can own that piece of the market, while others are going to be forced to increase either their fee rate or add risk parameters around their originating practices.
What happens if you outperform AirDNA?
There's nothing at this point. I should say if the individual, if it's a refinance transaction, right, and you have 12 months look back and it outperforms the AirDNA, we're just going to take the 12-month look back, right? That's more reliable than AirDNA.
Mm-hmm.
That's actual data, right? That's receivables. In a lot of cases, we can look forward. There's some clients that we worked with recently that have, X amount of bookings going into 2022, and just those bookings alone are enough to satisfy the 1-to-1 ratio. So I think that actually, that's a good point you bring that up. I think although investors aren't thrilled about AirDNA, they are happy with short-term rental type financing out there. And I think what they're going to do is open up a little bit more consideration. For example, right, if I have an individual come to me and they have no short-term rental experience and they want to put the minimum down payment of 15% down, and let's say this is a higher purchase price, let's say it's north of 700. And typically we would have to default to using long-term rental to satisfy that 1-to-1. That gets very tough. Right now, we can still do the loan regardless. If it doesn't hit the 1-to-1 ratio, we can do the loan, but there's an increase in interest rate. How do we avoid that increase in interest rate? I think you're going to see the investors look if that subject property has a history of ownership of short-term rental activity. We can use, I think what we're going to see in lieu of the 1007, we can use the subject property. Again, we're not so much concerned about the individual. We're more concerned about the property. So I think, and again, once a quarter, we get to go to these investors and say, hey, this is what we're seeing. This is what we'd like to do. We're going to work on a new forward commitment. Right now, today, if a first-time STR investor is buying a subject property and we have to use LTR, but that, I'm going to be like, okay, the property's proven. The property has proven that it is a great STR investment. Let's use that to gauge the eligibility rather than the buyer itself and their history. So I think that's what we're going to see, is more, guidelines and risk parameters opening up around subject properties with a proven STR history, as where, they're still trying to get completely comfortable with just AirDNA.
Gotcha. So and I hear everything that you're saying. It's almost like the experience or the history, the track record of the host is not going to be relevant. It's not relevant today and even moving forward. And what I mean by that is if you had 8, 10, 15, 20 properties that you could run through AirDNA and show that you're outperforming by 30 or 40% portfolio wide, they wouldn't be able to take that into consideration.
Yeah, right now there's a hard, fast rule: must have 1 year short-term rental income or ownership operating history for us to use STR income to satisfy the 1-to-1 ratio, right? Which, I would say maybe 3 out of 10 applicants that come through want to buy an STR, but they have no experience. They're trying to jump in, and we're like, okay, well, we're going to have to use long-term rental income to make this deal work. And are we going to hit the 1-to-1 ratio? It gets very tough when you're putting just 15% down and using long-term rental income to satisfy the 1-to-1 ratio. I think what I'm going to push for with our investors in this new forward is taking into consideration the subject property itself, because oftentimes I've seen they come in, they're like, I'm going to buy this. It has a history of short-term rental income. Can we use it? Today, the answer is no. But once a quarter, we meet with our investors and we get to put in new risk parameters or underwriting guidelines. And I want to see the subject property being considered more often.
Gotcha. That's a great answer. I do most of my purchases outside of my DTI. Where do you see rates for investment loans in the next 6 months to a year? My last was 1.5 million at 3.75 with a 15K buy down.
Okay, so it was a 1 point buy down to get an interest rate of 3.75, and I'll assume that that's on a 30-year fixed. Where do I see interest rates? Where's that interest rate going to be 6 months from now? I think that interest rate's probably closer to 4.
Gotcha. Let's see. What is the minimum percentage down required for DSCR if we want to qualify for a loan based on AirDNA data, not LTR?
15% if the individual does not have any short-term rental income history, and it does not meet the 1-to-1 ratio, the minimum down payment requirement would become 25%, right? So let me kind of touch on that for a second. DSCR loans, we can, even if the property does not 1-to-1, right? We do not meet that 1-to-1 debt servicing ratio. We can still do the loan. There's just a 0.5% increase to the interest rate. Now, one of the things that we're doing on our end right now is eating that 0.5% increase in interest rate. We can't do anything about the LTV. It still needs to be 25% down, but we're eating that 0.5% increase in interest rate. So I'm sorry, refresh the question one more time. Can you throw it back up there? Oh, that's good.
Which one? Going back, I should have left it up. I got to go back and find it.
To answer the question specifically, the minimum down payment requirement is 15%.
Yes. I can't find the question. There's too
It's
many
okay.
of them. I apologize. So let me use myself as a use case, because I want to reframe the question I asked you previously, and I think I already know the answer. I've been doing this a long time. I outperform multiple properties in my portfolio, well over 1 year experience, and I outperform my entire portfolio at about 41% higher than the 90th percentile on AirDNA, which is typically higher than what you would see in just typing in the address and getting the Redalizer report. I'm going to buy potentially the biggest property I've ever purchased, probably over $2 million in Montana next week, and I'm going to be calling you if I decide that I need to make that. AirDNA shows on this specific property right now about $141,000 in rental income. I'm going to have roughly $600,000 in 1031 funds. I factored everything in. I know what your rates are. I know what my originations and all that type of stuff. It's going to be about a $13,000 a month mortgage. So I've got a $1,000 a month delta, right? AirDNA is going to roughly show $12,000 a month in revenue. My mortgage is going to be roughly around $13,000. But the history of me outperforming is irrelevant. So does that mean I will have to pay an extra 0.5 point on the interest rate?
Well, no, because you have that $1,000 delta that you talked about. You're going to be coming in with the 1-to-1 ratio. If it didn't have the 1-to-1 ratio, then there would be an increase in the interest rate. At this time, we're at the lender retail, we're eating that 0.5% increase. So no, I mean, you're not going to see an increase in interest rate because you are meeting the 1-to-1 ratio in that case. It's a situation of good is good enough, right? As soon as you hit that 1-to-1, you're good enough, right? There's not extra credit or anything given when you're outperforming the 1-to-1 ratio. At least today, we have a product that's called the Noni Plus or the DSCR Plus, where when you put 35% down or certain characteristics of the loan, we'll actually give you interest rates below 4%. And actually, now that you mention it, I think that might be something to bring up in this quarterly meetings with these hedge funds is when the DSCR ratio is X greater than the 1-to-1, could we improve the interest rate? And then the truth is yes, now that I think about it, because this is the way these loans sell is really determined off the loan characteristics, right? Loan to value, FICO scores, and DSCR. right? You get credit on the sell of the loan based off of the DSCR, how much greater than 1.1 it is, or lesser, right? When it's lesser than 1.1, we sell it for lesser and take a hit. And we do see a marginal increase on the sale of the loan when the 1-to-1 ratio is greater than. Now, if it's, say, 30% greater than, we should be able to maybe drop the interest rate an eighth or a quarter%, and we'll lose money off of the lower interest rate, but we're making money off of the higher DSCR, which is, probably something we could bake into our rates and the way we offer our DSCR loan products in the coming quarters.
Gotcha. Cool. Thank you. For new construction where there is no air DNA history, will you use a subject property in the neighborhood? 15% down an option or something like this?
Exactly. Yes. We're going to use comparable data from subject properties within the proximity of comparables within the proximity of the subject property. So other, let's call it a 4.3, 2,600 square foot property within the proximity of the subject that has STR data on it, we'll use that to determine the cash flow of the subject property, and the 15% down is an option.
You offer HELOCs on second homes or investment loans?
No, this is a frequent question. The lender does not offer HELOCs on second homes or investment properties. I have done a little bit of research on that. There's an outlet out there, Spring EQ. It's Spring EQ. They are basically a second mortgage lender. They do fixed seconds, standalone seconds. And they do have a retail outlet. It's not something that you have to work through a broker on. So I'd look at Spring EQ. Navy Fed is another good option for the HELOCs on investment properties. And Quorum Financial is a credit union that does a really, really good job on the second home or on the HELOCs.
Awesome. All right, let's take two more questions. If you guys have a question, then I'll get Chris out of here in our 45-minute window. We can all get back to some football. So minimum price is $150 and minimum size is 600 square feet. Is that correct? I suppose somebody's looking at a tiny home or a condo or something.
That is correct. Minimum loan amount is $150,000, and the minimum square footage on the subject property is 600 square feet.
Let's see. Would a higher credit score factor into getting better interest rate, or are you just using one cutoff credit score?
Great question. In the coming weeks, you're going to see adjustments made to our rate sheet. Right now, anyone above a 680 credit score, anyone above a 680 FICO gets the same interest rate as someone with a 740. We looked at that, myself and my partner, Deb, and it shouldn't really be that way. If you have a 685 FICO, you should not be getting the same interest rate as a 740 plus FICO. So there's going to be some adjustments made to the rate sheet in the coming weeks where better interest rates are available per, the higher FICO tiers.
And I can't emphasize to you guys if you're like me, I'm in the middle of rehabbing 2 houses right now. I just got done furnishing my new construction house. It seems like I've always got a project going on, which means that my credit card is literally $10,000, $20,000 a week. I keep Credit Karma or one of those apps, on my phone so I can see roughly where it's at every single day. But I think something that's really important. So I'm getting ready to do a purchase with Chris, probably at least within the next 30 days to start the process. That means I've moved my process from paying off my credit card once a week to twice a week. So now literally every Tuesday and Thursday, and what happened is literally yesterday was the day to where it goes back to my Southwest Chase Visa, and that's the reporting day. I missed the payoff period last month, and my credit score dropped 41 points because I had $11,000 in debt on my credit card. It paid off to 0. I saw that come through, jumped 41 points, went right back up. And I hover around 790 to 810. I think the last deal I did with Chris, I was at like 792. And that's going to be really important if you want to get the best interest rate. Traditionally, as Chris just said, that's what I love about that last question. It was 680 or higher, but hopefully I will get a little bit of a benefit to keeping my credit score higher. And I think a lot of us that are doing multiple STRs. We're going through the winter. You might be doing some rehab. Just pay really close attention to when your credit card is actually reporting to the bureau, and make sure you're paying your balances down, not necessarily on your statement and when the payment is due.
Yeah, absolutely.
Chris, thank you very much for joining me today, especially on a Sunday and a football Sunday. I know Tad Forbes from Texas probably isn't watching it because I think the Cowboys game is on already. But do you have anything that we didn't cover that you want to part with?
No, I mean, I think the outlook for what we do, what we're interested in, as STR owners, operators, financing, the technologies, I see, this industry, this little cottage industry of short-term rentals within the real estate market itself is growing. The momentum is significant. You're seeing, once institutional money starts getting involved in these type of cottage industries that we're experiencing with short-term rental, that it's got a good runway ahead of it. So I would say, just keep doing what you're doing. There's plenty of deals out there. Use the tools that are available. The financing's got a good road ahead of it. And if you have any follow-up questions, you know how to get a hold of me. Either direct message me on Facebook, message the Lender Investor Loans Facebook page. And I think at the end of the day, the way we want to earn your business is by giving you the best information so you can make informed decisions.
Awesome. I really appreciate it, Chris. And just to I'll give my 2 cents. I've used them on my last 2 deals that I've done. I bought a lake property. I bought a beachfront house. They're very easy to work with. Dscr, who he mentioned, is the one that takes great care of me on the back end while Chris is out skiing or playing golf or whatever he does. Probably doing research, actually. But I can't recommend them enough. If you are in one of my paid programs, as Chris said, you do get 50% off of your origination. That alone, if you're buying a $700,000, $500,000, probably even a $400,000 property or higher, is going to pay for itself. I am also a believer, most importantly, that we need to take advantage while interest rates are low. That's why I've expanded my portfolio outside of really what I wanted to cap it at. Over the last 4 months. Now I'm selling 2 properties to roll into a bigger property so I can reduce that number, but also to buy that dream home. And one thing that I think, if you're brand new, if you're looking to get into this, or you're afraid to expand and you're going to sit back on the fence and you think that this market is going to correct and you think that we're going to have a 2008 or a 2009, I'm here to tell you that every day that you do not get into this game, you are losing money. We might see a softening, but we're not going to see a major correction anytime soon. Do you agree with that, Chris?
100%. I do.
If you do some research, just do a Google search of the available home inventory in the United States and find an article, find some data about the historicals. And we're like around 1960 of available inventory right now. We would have to build like 7.5 to 8 million homes a year for 7 years to be able to get back to where we were pre-COVID. It's not going to happen. So that means that you are missing out on rental income now.
Yes.
And understand, you are buying a business when you buy a condotel, a house, a boutique hotel, a cabin, whatever you're doing, and you're buying on the cash flow. And if you just so happen to invest into a market that's appreciating, that's kind of the icing on the cake. Yes, so that's my 2 cents. Awesome. Chris, thank you for joining me, buddy. Let's go watch some football and have a great day. Thank you, everybody, for joining us. As always, if you have any questions, if you're watching this on the replay and you have a question for me, just tag me. If you have a question for Chris, just tag Chris. And, he's tremendous at responding. I'm okay at it. Actually, I've spent like 24 hours a day on my Facebook. So have a great day, everybody. Look forward to seeing you on the next one. And thank you, Chris.
See ya. Have a good day, everyone.